This is Declarations.
I think ebullient, flowing, healthy credit markets only benefit the seller, not the buyer. This is the kind of market environment where the buyer has to be creative on how they finance stuff. But if you can do that, odds are you're going to make some good investments.
Hi, I'm Todd Rich, co-founder of Declaration Partners and head of our real estate investing business. Welcome to Declarations, a podcast where top investors and business leaders can share their insights and provide an independent perspective. Today, we have the distinct pleasure of speaking with Bennett Goodman. Bennett is perhaps most well known as the G from GSO, which after acquisition by Blackstone became known as Blackstone GSO, and then simply Blackstone Credit, now a major investment platform, managing more than $125 billion. But there's a lot more to Bennett. He's also the founder and executive chairman of Hunter Point Capital, an investment firm that provides capital to proven asset management GPs. Bennett also chairs his family office, called Hunter Creek, and we are proud to count Bennett and his family office among our investors here at Declaration Partners. Philanthropically, Bennett and his family have been extraordinarily generous with their time and their capital. In addition to substantial commitments to Lafayette, his alma mater, the Goodmans have specifically targeted income inequality through their gift to Year Up and its job training program. Among Bennett's many accolades, he received Institutional Investor's 2012 Money Manager of the Year Award and Euromoney Magazine's Lifetime Achievement Award. Now I'd like to welcome Bennett to the show. Welcome, Bennett.
Thank you, Todd. Pleasure to be here.
Well, thank you. Bennett, as you may know, I like to start these discussions really in the same way. What is your declaration? What is your mission statement, your guiding principle for investing and in life?
I'd like to make a difference. In all the organizations and entities that I've been involved in, I'd like to think I help make them better one way or another. And I kind of take that approach to the firms that I have started, whether I'm talking about my philanthropic activities, but also my family activities. I've been very fortunate in my career. Never underestimate the luck of timing. And I'd like to leave the world in a better place than what I've been able to enjoy. And I think that is a challenge and a responsibility that I take pretty seriously.
Well, you mentioned your foundation, where you started, how you grew up. Maybe let's dig into that. I understand your father passed away when you were quite young, and your uncle, who was a legendary LSU baseball coach, Skip Bertman, was pretty influential in your upbringing. Can you just tell us a little bit about where you grew up, how you grew up, and maybe his influence to the extent that that's relevant?
Uncle Skip, as I refer to him as.
What a great name.
Yeah, really is like a father figure to me. I was born in Miami Beach. My father contracted cancer when I was 3. I, at the time, had a 1-year-old brother. My mother, who never went to college, decided that the best place for my dad to get cancer treatments was actually in New York. And unfortunately, he passed away at 5. My uncle, who also lived in Miami Beach, was effectively my father and a very, very influential figure in my development.
He's famous for the 3 H's of success.
He is.
I guess Uncle, as you would would have said, hard work, honesty, and humility are the keys to success. How did that philosophy impact you and your upbringing?
Yeah, quite a bit. So I love bragging about my uncle. He is the winningest coach in the history of the NCAA for baseball.
Wow.
I think he has 5 or 6 World Series championships as the coach of the LSU baseball team. He took a sleepy baseball program at LSU, which is really known for its football prowess, and built national champions for baseball. And the way he went about it, he wasn't just an extraordinary baseball coach. He was a great businessman. And he figured out the way to build a program is to get the alumni and the community involved. And he did that through the stadium. So at a very early age, like I'm in high school, I'm watching my uncle get local merchants to take a advertisement in the baseball stadium and he built up a pretty good revenue base, which he then reinvested in the program. And this is a baseball coach, not a businessman, and it definitely had an impact on me. And when I was ready to kind of start my career, I remember sitting down with him, and he was asking me, "So what kind of career path do you want to do?" And I said, "Well, I think I like this world of finance." And he said, "Make sure you remember the three H's, which, as you cite, hard work, honesty, and humility."
Your uncle Skip's influence at LSU baseball has continued to this day, as you, I'm sure, know, right? One of the best pitchers in the current major leagues just graduated from the LSU baseball program, right? So,
He had a specialty with pitchers. I think he's got more pitchers in the major leagues than any other college coach ever.
wow.
And his background, he was a catcher. He actually played for the Cincinnati Reds for a few years before he injured his knee, and that kind of ended his career. But as a catcher, you are kind of controlling a pitcher.
Sure.
And he applied that experience in terms of recruiting, developing, mentoring many major league pitchers.
Fascinating, and let's hope they send a couple of prospects over to the Orioles over the years. But
absolutely, we'll have to go to a baseball game in.
Exactly. But let's you started talking about your career after Lafayette, Harvard Business School. I guess you went to Drexel. Is that right?
So I went to Drexel, and
With Mike Milk.
after about 3 or 4 years, I check in with my annual visit with my uncle down in Baton Rouge, and he's asking about my career, and I say, "Oh, it's going really well. It's fascinating." And he goes, "Did you remember the three H's?" And I said, "Skip, of course I remember the three H's. But in the world of Wall Street, everybody works hard. I believe everybody is very honest. But humility, that is not a characteristic that I detect among, the giants in this industry." And he says, "That will be their undoing." So here is a baseball coach at Baton Rouge. Think about the prescience of that statement, that the lack of humility will be the undoing of Wall Street.
Well, it does seem that you've built your career in a different way. Just having gotten to know you, I think you exhibit humility, and I think it's.
I try. That's really a tribute to Skip and the three H's, which when I became more of a manager, particularly at DLJ, where I was like leading a big business, I used to talk about the three H's all the time. My colleagues would roll their eyes because I would always go back to the three H's. And
well, I think it's clearly worked. Let's talk a little bit. So you mentioned Drexel and DLJ. I think I heard an apocryphal story that you almost missed your opportunity, I guess, to get into finance. You were apparently playing a pickup basketball game, and I guess you have been doing well. It was
I was in business school, and the way it worked was all these firms would come to campus. You'd try to enroll, and you kind of had to get accepted. And when the enrollment opened up that afternoon, I was in this basketball game, and we went into overtime, and I really did not want to leave. Probably not exercising very good judgment, quite frankly. But
well, did you win?
We did win the game, but I kind of lost out as a result of being able to interview with firms like, Goldman Sachs, Morgan Stanley, First Boston, which were the three really hot firms back in, this is now 1983. And the only firm that I could register for, to me, was a firm I never heard of, called Drexel, Burnham, Lambert.
Yeah. Well, it seems to have worked out. And obviously, looking backward, Drexel was really at the fulcrum for credit.
Yeah.
And obviously you grew most of your career building a credit business. So let's talk about that, if you don't mind. Maybe what you learned in the credit space, the opportunity that you saw, and ultimately to the founding of GSO.
Yeah. So I really didn't know what I was doing coming out of business school. When I got my offer to work at Drexel, people, that didn't impress anybody, quite frankly. And what I was able to do was, again, luck of timing. It's 1983. Ronald Reagan is serving his first term. He inherited an economy from Jimmy Carter. Jimmy Carter had somebody in the Treasury Department, I think named David Rubenstein. And David and his colleagues at Treasury somehow managed to create interest rates, government bonds, 10-year treasuries like at 12%, and inflation at like 10+%.
I think they peaked. They were really, the inflation has never been so high as what they were able to do.
Well, thanks to the misery index of 20-something percent, which was like in the late 70s, Ronald Reagan comes in and interest rates go from 12% all the way down for the next 40 years, by the way. But because of the decline of interest rates in the relatively early 80s and the globalization of the world economy, finance became very, very active. And Drexel, Bertman, Lambert had a monopoly in financing junk-rated companies rated BB and below. I didn't really understand all that, when I was interviewing them when I got the job. They said they were an investment banking firm. I wanted to do investment banking, so I went with it. But when I went back and was, having a beer with my buddies at business school, they're like, "You're crazy. Like it's not a real firm." I go, "What do you mean it's not a real firm?" They said, "Well, they're not really an investment bank. They do some esoteric, weird thing called junk bonds. It's not really investment banking." I go, "Well, why not? Like, what is it that you do?" He goes, "Well, I work at Goldman Sachs, and they do like industrial revenue bonds for great American institutions like Dow Chemical." I said, "Oh, okay, that's interesting. Well, these guys do bond deals for companies you never heard of. What's the difference?"
And yet, if you look at the Hall of Fame, if there were theoretically a Wall Street Hall of Fame, I couldn't count how many came out of Drexel, but a lot.
The diaspora of talent
Yeah.
that came out of Drexel is phenomenal.
So what are the lessons there?
Yeah, because they had a monopoly, because I was lucky enough to get a job there, I probably worked on one transaction every month. Could have been a junk bond, it could have been an IPO, it could have been a merger deal for this very active junk bond rated universe of companies. But my buddy at Goldman, who did the industrial revenue bond for Dow, worked on maybe 2 deals a year. So I'm working on 12, he's working on 2. Compound that over 5 years. I've worked on 60, he's worked on 10.
Wow.
I have to be smarter. I have to be better. I have to be more experienced. I have to have more judgment.
Yeah.
So the takeaway, as I applied it to later in my career, you want to get to the plate, you want to swing the bat. It makes a big difference. And Drexel had a culture around solving problems. Junk-rated companies are messy.
Yep.
There's usually something wrong with them. And the world of credit analysis is all about trying to identify the weaknesses in a company's business model and how to structure some kind of a loan that recognizes those risks and protects the investor.
Now that's going to be a skill set that's even more important today, where perhaps we don't have the next 40 years of declining interest rates. Perhaps that era
Absolutely.
is over.
In a bull market, anybody can get a deal done. The only thing that matters is when times are tough.
Right.
That's when you'll learn.
Yeah. What was the opportunity that you saw, I guess, to do your own, and how did you apply that when you found the GSO?
Yeah. So, kind of starts really from my transition from Drexel to Donaldson, Lufkin, Red.
DLJ.
I got a call from a guy named Tony James, who at the time was running the investment banking group at DLJ. He wanted to build.
Most listeners know, by the way, but Tony James was subsequently at Blackstone, where he became vice chairman, and I'm sure we'll come back to his name. Hi, this is Todd Rich. Thank you for listening to the Declarations podcast, where top investors and business leaders share their insights and provide an independent perspective. We hope you're enjoying this episode. If you'd like to learn more about Declaration Partners, please visit our website at www.declarationpartners.com. And now back to the episode.
Tony wanted to build a high yield bond, leverage lending, distressed debt, mezzanine origination capability. And somehow I got connected to Tony, and I was really impressed with, his vision and his intellect. And, I thought he'd be a great mentor. So I leave Drexel and I go to DLJ, and I apply all the knowledge and all the relationships that I had among issuers to help build a high yield bond leverage loan. We called it leverage finance in the early 90s practice, which eventually we became the number one firm in that area. Helped a lot by the fact that Drexel had some regulatory issues.
Very shortly after you left, if I understand.
Right. It had nothing to do with my departure.
I know that.
But again, I come back to luck, and when I went to DLJ, it was really because I had such confidence in Tony James.
Right.
Tony had a plan, and he had thought it out really well. And the demise of Drexel was the biggest benefit to DLJ because we were then able to recruit all these great bankers into the firm. And as you referred to before, Todd, there was such talent at Drexel, and now they all needed a new home.
Maybe fast forward to how long you were there before you decided.
Yeah, so I was at DLJ for about 15 years. Great firm, terrific culture. It was a little bit like Camelot. Every day felt kind of magical. Being the underdog, people don't appreciate this. No one ever expected us to win anything at DLJ. And for us, every victory we savored, and it was really fun kind of building that stuff up. But eventually the banks got into the business. JP Morgan, Bank of America, Citi, and they used their balance sheet, but a $300 million balance sheet, competing with firms that had $50 billion balance sheets. So we decided we need to sell the firm. And in November of 2000, we wound up selling DLJ to Credit Suisse. And that's how I found my way into that firm.
Got it. So eventually you did make it back to the First Boston.
Yeah, I backdoored my way into a firm that would never hire me back in 1983.
But that worked out well, not just for you, but for them, right? You grew that business.
Yeah, it was all they really wanted was our leverage finance and merchant banking activities. They didn't really care for the rest of DLJ, and they bought the firm at the top of the market. And shortly after they acquired us, the market turned. But in a move that still perplexes me, the then CEO of Credit Suisse decides, if we're losing a lot of money in investment banking, either I fire somebody or I'm going to be fired. So he chose to fire Tony James.
Wow. Okay.
Tony then decides to go to Blackstone, and I went in to resign because I really liked working for Tony. But they asked me to stick around for a couple of years just because they had just spent a lot of money buying DLJ. And I did have, 500 people within my world that I didn't want to abandon. But I did tell them I am going to leave one day. I just want you to know. We worked something out where, I stuck around for another year or two, but I was able to take my two key lieutenants, Trip Smith and Doug Ostrover, to start a new firm.
For those who are less good at phonics, I just want to point out that was a G, an S, and an O.
There you go. GSO sounds a little bit like a government agency. All the good names, by the way, were already taken. So we decided with that acronym to leave what was then Credit Suisse to start GSO. And we were specialists in the credit world. And we had a hedge fund that allowed us to make very illiquid investments. So we were able to not just buy high yield bonds and loans, but we could do mezzanine investing. We can do distressed debt for control. We can do, actually, we even did some small cap private equity deals.
And how did you fund yourself? You no longer had the bank sheet at that point.
It was a function of the times.
Right.
This is now 2005, July 4th, I remember, 2005. And we're not only able to raise a multi-billion-dollar hedge fund, we're able to take up to 50% of our capital and do illiquid things. Wow. Can't do that today.
No. It was an easier fundraising environment, I guess.
It was a much easier fundraising environment. at GSO, we did a good job for our LPs. And then that guy, Tony James, resurfaces. He's taken Blackstone public in the summer of 2007. And the day after he finishes the IPO, he calls me up and says, Blackstone wants to acquire GSO. We want you to become our credit arm.
It really strikes me that in addition to the business story that I'm sure you can tell about the growth of credit and levered finance and all that, it's really a people story. It's really about getting back to work with someone that you trust and that you believed in. And he must have felt the same way about you.
I couldn't agree more. I think I was very fortunate to have amazing mentors in my career. Mike Milken was an amazing leader, a brilliant mind. Now, there were probably on an org chart 50 layers between me and Mike Milken. But if I was in a meeting, he would ask my opinion. He was so good at wanting to hear the voices of different people. And it taught me one thing: never go to a meeting without tremendous preparation.
Yeah, what a great lesson.
And I was obsessed with over preparing for the fear that Mike would ask me a question and I wouldn't have that answer. And Tony was very much the same way. The investment committees at DLJ and then at Blackstone were legendary for the fact that Tony would always go around the room and ask the most junior associate, what do you think about this deal? By the way, I want to recall my Uncle Skip.
Okay.
Skip, during practice, you never were able to go through motions. If you're going to practice under game time conditions. Don't spend a minute practicing anything that you wouldn't do for a game. So Skip's players were incredibly well prepared. Same thing for me in the business world. I want to be more prepared than anybody else going into that meeting.
Is there maybe a seminal story, a deal or something that really exhibits that? Some maybe a transaction that happened early on in the GSO or in the Blackstone life that really where it stood out, that your preparation, your hard work, your diligence really allowed you to succeed?
So we go out and we buy $4 billion worth of bridge loans that Citibank couldn't distribute. And Blackstone had just closed the acquisition of GSO. So it was like front and center. So we have $4 billion of exposure. And then Schwarzman, the CEO of Blackstone, was very curious about this. And, he had us go up and explain the deal. And we bought a package of loans at 82 cents on the dollar.
Okay. Citibank
gave us 3-to-1 leverage at LIBOR plus 100. It was a really clever, well-structured deal.
Yeah.
And Steve said, what are the returns? And I said, well, we think the returns are 20+%, and we think we'll get that over 5 years. And we went through, he goes, what's the downside? So we went through our downside analysis, pretty thorough examination of what we did. He goes, this is smart. I'd like to put some of this into our private equity funds. And then Lehman Brothers goes bankrupt in September of 2008. The world gets turned upside down. Our loans go from being priced at 82 cents on the dollar to like 40 cents on the dollar, but we had leveraged it 3-to-1. So in effect, we wiped out the equity.
Yep, on a mark-to-market basis. But
on a mark-to-market basis,
so let's talk really happened.
We didn't have to mark-to-market the liabilities; they were fixed. But from a true economic point of view,
yep,
we somehow destroyed $1 billion of equity.
Right.
Which, the course of 9 months, that's pretty hard to do.
Right.
So Schwarzman calls me into his office.
Right.
What the hell just happened? And I thought I would be fired. I mean, I remember going home to my wife. I said, I don't think I'm going to be able to survive this. And Steve was pretty hot because we embarrassed the firm. And I was saying,
right,
it's all mark to market. We're fine. These loans will come back. How do you know they're going to come back? Why are they trading so poorly? They've never traded this bad. This recession could go on. And I'm like, well, hang on. Remember that downside analysis. We're a lender. We have asset coverage. If every company defaults, we'll work through it and we'll get a good recovery. We're not going to make 20+%, but we'll get our money back. One thing led to another, and the markets came back. They recovered. Right. Our loans went from 40 to 50 to 80 to par. And we wound up making.
And you never needed to, restructure the debt with Citi.
Never had to restructure anything because the liabilities were fixed and we had long dated maturities, no mark to market leverage. It was a clever structure.
It was just time.
It was just time. And that was the deal where GSO really earned its reputation because, we were under a lot of scrutiny. We were part of a public company disclosing the fact that, we had something that we wrote down on a unrealized basis to almost zero. And then it came back and everybody was happy. And, I was actually the subject of a Harvard Business School case study.
Oh, that must have felt good. Good.
But all's well that ends well. But that was the deal. That was the one.
Bennett, I can't help myself as a real estate guy, and I'm seeing now that we're in a bit of a credit crunch. It doesn't feel in the same way with the bank failures as it did in sort of 07 to 08. But in some ways, there are parallels. In some ways, maybe it's more difficult. But you had a 500 basis point interest rate increase, at least the short rates. There are plenty of people with bridge loans. Similar to the story you described at Citibank, who were hoping that they would be taken out at much lower interest rates, and they're stuck. How do you see this playing out? Is this just time, or do you think there's been a real destruction of value that's permanent, or do you think it's the same thing? It's just the short term, and maybe we'll stay with the residential sector.
Yeah. So 2008, 2009, there was a recession. It was a classic recession. We call that cyclicality. And cyclical risk we can analyze. We know how long recessions last for. We know how deep they go. We know how long it takes to recover. We can model it. We can analyze it. We can look at empirical data. We could set up Monte Carlo simulations with tens of thousands of different scenarios. We can come up with a distribution of returns based on those different outcomes of how long it takes to get to a recovery. That is very different than secular risk.
Right.
Secular risk, the business paradigm changes. So the analogy I'll give with office buildings in, B locations, I feel like in real estate in that sector, B-rated office towers in Manhattan, that could be going through a secular change.
Oh, there's no debate. I agree.
Work at home. So I don't know how great an opportunity. On the other hand, Class A office towers in New York are enjoying great rents. I think because the real estate credit markets are still kind of jammed up. There's so many spaces within real estate apart from office towers that is a great opportunity. Whenever the banks are retrenching is a great time to be leaning into investing because that circumstance won't last forever. But I do think it's a great time in your space, Todd, to be deploying capital in the broadly defined real estate sectors of the market.
Look, we happen to agree, and I'd say it's not just the bank sector. Actually, the equity sector, in our view, is also disrupted, and it isn't just the private non-traded REITs that people have talked about. It's actually the institutional space. I mean, if you look at what they call the Odyssey space, the open-ended diversified core equity funds, which are really institutional products, there's currently a $53 billion redemption queue. That's investors who are seeking to get their money out.
Wow.
And so when you have a combination of bank pullback and equity pullback, as you pointed out, that means nobody really wants to be in. And pricing has fallen to the place where we at least feel it's pretty compelling.
Yep.
It sounds like you agree.
I think in your world, you can look at replacement value. You are buying hard assets. To me, I always find the best investing we did is when the credit markets were the most disruptive. I think ebullient, flowing, healthy credit markets only benefit the seller, not the buyer. This is the kind of market environment where the buyer has to be creative on how they finance stuff. But if you can do that, odds are you're going to make some good investments.
Thank you for listening to the Declarations podcast. We hope you're enjoying this episode. If you'd like to learn more about Declaration Partners, please visit our website at www.declarationpartners.com. And now back to the episode. I'd like to turn from GSO to your next chapter, if you don't mind. Clearly, you had a ton of success with GSO, and then the sale to Blackstone. You mentioned that first deal, which worked out. Many others worked out as well, and it was going great. It's actually to the point I believe Blackstone Credit is perhaps the largest credit manager. It's certainly very large, with about 130 or 140 billion dollars of assets under management. And yet, you sought to leave and to start something new. Actually, you started more than one thing new. You started Hunter Point and Hunter Creek, which we'll get to. Why? What were you thinking? What are you aspiring towards?
So I had accomplished all that I had set out to do at Blackstone. I wanted to build something, big and substantive and consequential. But in the world of Blackstone, that's really all I wanted to do. Like, I didn't aspire to take on other managerial responsibilities at the firm. And I view myself as an entrepreneur in the financial world. So I like starting businesses. DLJ was a great example of that. GSO was a good example. And I always felt, even in Blackstone, like I was an entrepreneur. So I was very focused on succession. And once I had a plan that the firm was okay with, I was always going to go off and do something else. And I had to figure out, how do I leverage my experience, my history, my relationships, the LPs that I knew, and do something in the investing world that didn't compete with GSO. That was the key.
What did you come up with?
So at Blackstone, there was this unit that I was involved with called GP Stakes.
Right.
They bought minority stakes primarily in private equity firms that had not gone public. And because I did a lot of business with private equity firms, I get involved with their deals. I'd help them out with due diligence. I knew their reputations. And what I noticed was there were two or three very capable competitors, a firm called Dial and a firm called Petershill, which was owned by Goldman Sachs. And they were essentially financial buyers, meaning whoever came up with the highest price won an auction. And then they would kind of sit back and passively collect whatever dividends those private equity firms threw off.
And now the theory, just to explain to listeners who might not be quite as familiar, the theory with GP stake investing, whether the way that those groups did it or what you're about to explain about how you do it at Hunter Point, the theory, I guess, is that being an owner of the private equity firm entitles one not just to the returns of the underlying funds, but also to some of the other income streams, whether it's the management fees or the carried interest, or perhaps at scale, then perhaps there's even franchise value associated with the manager. Is that correct?
Exactly. And the firms that those three firms targeted tended to be the largest private firms in the industry. So, firms with $100 billion of capital under management. And they were all good firms. And that is a good strategy, but it's very much a passive strategy. And I thought there was an opportunity to be more of a strategic partner for growth among middle market GPs, firms with 10, 20, 30 billion of AUM.
They have to buy a firm that already had scale and just grows with more scale. And you're trying to seek them out at the inflection point where they are about scale.
Exactly. And when I say strategic, there are three things that most private equity firms would say are the keys to their success. One, they have to have good fundraising capabilities. It's a very competitive world. LPs are concentrating who they allocate capital to, and vital to the long-term success of a middle market firm. Two, They have to be able to create enterprise value for their LPs. They have to be able to differentiate themselves from an investment matter and have better returns than a Blackstone or a Carlyle or a KKR that have the benefit of great brands. So you got to outperform those firms to get the attention. And thirdly, the key to any one deal is the quality of the management team at the portfolio company level of who's managing, the acquisition. And to address those three areas at Hunter Point, we have a large capital formation team where we help our GPs raise LP capital. We have a group purchasing program where we built the scale, like a group purchasing program amongst all of our GPs. We go to healthcare providers, IT providers, airlines, FedEx, and we say, you can have all of our volume, but we want a discount. And then we pass that discount along to all of our GPs. And on average, we think we can improve EBITDA margins potentially up to 300, 400, 500 basis points for a typical mid-market firm. And then lastly, we have a talent development group that works with your portfolio company C-suite, mentoring, training, developing the CEO, the CFO. These are like executive coaches. And those three capabilities, capital formation, group purchasing, talent development, we do that for free. And that's our value proposition of how we try to distinguish ourselves, positioning ourselves to be a strategic partner for growth than just a financial participant as an equity holder.
And I want to point out here that and you just alluded to the fact that talent development is so important. That's clearly, that's a people-focused proposition. But it sounds like in your own business, when you sought to start Hunter Point, you also focused first on the people. And if I'm right, many of the people involved are people that you have known, whether it was from Credit Suisse or from other parts of your career. So this seems to come a theme. It wasn't just Tony James, but it's now even in your new business that it seems that you really value trust and longstanding relationships with great, talented people. Is that an accurate view of the history?
Absolutely. I think it's vital. At the end of the day, it's a very competitive world, and you need to have the best athletes that you can find. And there's no substitute for having history with an athlete.
You're looking to invest in a GP, in an asset management company, a PE firm that you're thinking about backing. You couldn't have possibly worked with all of them. So what is it that you look for when you're identifying an investment candidate?
Yeah. Three things. One, we want to see top quartile investment performance over the arc of time. For us, that's typically 20 plus years. We want to see, firms that have raised funds 1, 2, 3, 4, kind of trying to raise fund 5 when we meet them. Because we want to...
Got it. So not emerging manager program, really?
Yes, not emerging manager. These are established firms, been around for a long time. And what we're looking for is what caused them to be successful. Is it sustainable? Do they have moats around their competitive advantage? Who are the people that did the deals? Are they still the ones in charge? We're looking for realized results as opposed to just unrealized mark to market. And we try to assess that performance relative to benchmarks so that we're behind someone we think is a top quartile performer. That's one. Two, we very much focus on the culture of these firms. We need firms that are not only dedicated to investment excellence, but also to the notion of succession. We're long-term investors. We're going to outlive the founders. Who's the next generation? How are they compensated? How are they equitized? When is the transition going to happen? Do they know about it? So we need to have firms that have well-developed succession and equitization programs in place at the time of our investment. And then thirdly, we need firms that have the ambition to want to grow and become more consequential over time. Every private equity, credit, real estate guy you meet, everybody wants to grow, but not everybody has the DNA, the fundamental building blocks, the processes, the systems that allow for growth. And if we could find those three things, we think we'll find good long-term investments.
Those are great recipes for success. But I'd like to maybe talk for a second, not just about your professional activities, but also your family activities. So in addition to Hunter Point, which is this GP stakes farm you mentioned, you also created a family office, which you called Hunter Creek. What are you a big hunter? What's with the name?
No, I'm not good with guns or bows and arrows. So we have a home out in Colorado, and there's a body of water that flows through our property, and that body of water is a diversion off the Hunter Creek. So
Got it.
Hunter Creek Advisors is the family office, and we have a kind of a fancy little logo of mountains and a stream, so, which my daughter designed, and that is the name of the family office.
And what is it that you're trying to do with the family office? And I will maybe pause just with a moment of full disclosure to say that we're very proud here at Declaration to say that you and your family office have in fact invested with us. But I'd like to ask maybe, what are you trying to achieve? How do you think about family investing? There are some who say that family investing is in fact different a little bit from sort of institutional investing. You've obviously done both. So maybe a little bit about your thoughts there, please.
The headline is, we really think it's about the family. And the story behind the headline is, my wife and I historically supported a lot of things. Any one of my friends, they asked me to make a contribution, I made a small contribution. We spread it out. And there wasn't any strategy behind it. We just want to support our friends and good cause. We never said no to anything. And we had hundreds and hundreds of, small things. COVID hits, my middle son is engaged. Everyone's living with us under our roof, all three kids and their significant others. And we decide that we want to tell our kids in preparation of the wedding a little bit about the family foundation, and that we want them to, kind of get involved. So my eldest son, pretty thoughtful kind of guy, analyzes what we do and says, we'll only get involved. He's representing my other two kids, like as a union. He says, we'll only get involved if you make drastic changes. I go, what are you talking about? Drastic changes? What's wrong with what we do? He goes, this is the stupidest thing we've ever seen in our lives. You spread out your contributions like peanut butter on a piece of bread. There's no strategic thought. There's no monitoring. You're having no impact.
And he's specifically talking about your philanthropic contributions.
Yes.
Okay.
Yes. He analyzed everything.
Right.
And he said, our recommendation, if you want us to be involved, is that it's got to have a purpose. I go, okay, that sounds good. What do you think that purpose ought to be? And they all collectively say, we think we should try to address the wealth gap in America, and that we should concentrate our giving to try to promote shared prosperity, as I like to call it, and reducing this welfare gap. And they suggested that we hire somebody who knows something about philanthropic giving to help us think through how to do this. So they came out with like a study, like a strategic plan about 3 prongs of addressing this welfare gap.
Okay.
One is job training. One is education. And one is financial literacy.
And all related, if it sounds like it, it all relates really to the Chinese proverb, right? If you teach a man to fish, live, feed for a lifetime. Or I guess if you're, of the Jewish persuasion, maybe you'd read Maimonides. The highest form of giving is to actually teach somebody to, how to have a job for themselves. So it's really intended to be sustainable, is what I'm hearing.
Exactly. And my wife and I are thrilled. It's great getting your kids involved. And I love their sense of responsibility and taking leadership on this. And it's been a great thing for our family, for our daughter-in-laws and our future son-in-law. And we're really proud of, what they're doing.
Well, it's fascinating. If you don't mind, though, I'd like to go back just to the question of investing. How do you think about investing differently as a family investor? Is it really just support the philanthropic efforts?
Well, No, it's a little different than like my day job at Hunter Point, with the GP stakes. One, there's much more of a focus on after-tax gains because as a foundation, you want to give away a lot. And, I'm a credit guy, so before we set up the family office structure, I was invested in a lot of my GSO funds, 100% taxable.
Right.
So as we set up the family office, we went through this whole transition of how do we get more long-term investing capital gain. On the other hand, we want to give away a bunch of money. You got to have some amount of current income. So, we went through a whole portfolio construction of clever after-tax yield-oriented products, primarily in real estate, I might add.
You're not the only family investor who, by the way, seeks those same things out of real estate: long wealth accretion in a tax deferred manner with some income.
Exactly, exactly. But we do have kind of a barbell approach. We have a lot of liquid stuff so we can support the giving, but we have a lot of illiquid stuff, to compound the returns over time. There's always a tension of how to keep that in balance. How do we plan for the long-term capital calls of drawdown funds with keeping sufficient liquidity to, get a return? I do have a team of people that really take care of that. I don't, other than setting it all up, I don't really get that involved day to day unless there's like a big capital commitment that the team wants, my input on. But it's pretty self-sufficient. We laid out kind of the parameters around risk tolerance and liquidity and return expectation. There's a portfolio allocation across a bunch of strategies. We benchmark ourselves against the appropriate indices. They monitor that every quarter. But it kind of works on its own. It's a very good group of people. It allows our family to give away a lot of money. It allows me to focus on Hunter Point.
Look, that's it's great. It's I really appreciate you digging in on that. I think integrating your investing with your philanthropy and how it's all related to your family values, starting with your uncle Skip. I'm sure your mom was quite influential as well, and really seeing it grow. It's been fascinating. I really want to thank you for this interview. I do have some standard closing questions, if you're willing to indulge for a couple of more minutes. Maybe, was there a book that really influenced your thinking or your personal development?
Well, Uncle Skip wrote a book early in his career about youth baseball. And in that book, that's where he first came out with the three H's. That's where he came out with this notion of when you practice, visualize game conditions and only practice that. And I was in high school and I remember reading that book and I thought, whoa, this is what I need to do. So it was really, I think it was called Success in Youth Baseball. He was trying to apply it to like Little League, like get kids early on in Little League to think like this.
That's great. Okay, we'll put that on my list.
Yeah, I don't
Okay,
know if the book's still a publication. So.
we'll find one.
All right.
Maybe what was you may have already touched on this, but I'd like to ask, what was the best advice that you received from your parents, perhaps Uncle Skip, or that you give to your three children?
I grew up with an incredible mother who was 27 at the time her husband passed away, and it was me and my younger brother, and it was all about family. There's nothing more important. The support, the unconditional love, the friendship had a big impact on for me and my brother, and I try to instill those values that my mother built into our upbringing into my children. So there's nothing I'm prouder of. I've done a lot of interesting career things, but I would say the thing I'm proudest of really is my relationship with my wife and the children who, espouse the same values that Meg and I, like to practice and lead our life by.
So it's excellent. Love to hear that. Last question. The Declaration of Independence talks often about freedom for life, liberty, and the pursuit of happiness. What do you do in pursuit of happiness?
By the way, I love that life, liberty, and the pursuit of happiness. I use that a lot in my speeches.
One of the most famous lines in American history.
That's that as well as I use this other one, in pursuit of a more perfect union.
Uh,
Because the founders, the framers of the Constitution knew, this is a experiment. We're going to have to improve it over time. I have a lot of fun. Like I work-life balance is very important to me. The more balance I have in my life, the harder I can work. When my life is not in balance, nothing good ever happens. I am blessed. I'm on my first wife, and we're madly in love, and we have a lot of fun together. I'd say we're very active. We like activities, so we're constantly walking, hiking, biking, golfing, but love activity, physical activity. We also are very fortunate that we live in New York and we're exposed to a ton of culture. So we live on the Upper West Side. We are frequent visitors to Lincoln Center. Every night of the week, there is magic going on in those concert venues. And, we try to take advantage of that, but we're big fans of Broadway, and we're big art fans as well. My wife works at the Whitney Museum of American Art as well as the Metropolitan Museum. So art is a big part of our life, and we share all those hobbies together, which makes it even more enjoyable. So yeah, we definitely have a lot of fun.
it is clear that you have found, your happiness, which
Yes.
is great. Bennett, I just want to thank you for joining us here at the Declarations podcast. Thank you for your partnership and your friendship. Really, really appreciate you joining today.
Thank you, Todd. It was a pleasure. And don't forget, we're the fortunate ones that are the investors in your fund. So thank you for being such a great steward of the family's capital, and we look forward to supporting you for a long period of time.
This podcast is provided for discussion and informational purposes only, for use by Declaration Partners LP, together with its affiliates, referred to as Declaration or We. This information discussed in this podcast may change at any time without notice, and there is no duty by Declaration to update any person to whom this information is provided. This podcast does not constitute an offer to sell or the solicitation of an offer to purchase any investment product or any interest in the fund or any other investment vehicles or accounts managed or advised by Declaration, a Declaration investment product, in any jurisdiction to any person. Any such offer or solicitation for interest in any Declaration investment product will only be made pursuant to such Declaration investment products' definitive offering documents, which contain a description of the material terms, including risk factors, conflicts of interest, fees and charges, and regulatory and tax considerations relating to such Declaration investment product, and which should be reviewed carefully by potential investors prior to making an investment decision. This podcast does not constitute tax or legal advice. The listener is urged to consult a professional tax and/or legal advisors regarding the possible tax, legal, economic, regulatory, or other risks and consequences associated with any investment, and must be able to bear the risks involved. This podcast may contain certain forward-looking statements, which constitute Declaration's views with respect to future events, which can be identified by the use of forward-looking terminology such as intend, seek, expect, target, project, or endeavor. These statements are made based upon such views as they exist as of the date herein. There is no assurance that these such views are correct or will prove with the passage of time to be correct. Actual events or results may differ materially from those contemplated by such forward-looking statements as a result of factors beyond Declaration's control, including, without limitation, any disruptions in global, regional, or local financial, credit, or real estate markets, acts of God, fire, hurricanes, tropical storms, floods, earthquakes, or other natural disasters, outbreaks of an infectious disease, pandemic, or any other serious public health concern, war, terrorism, labor strikes, electricity shortages, or other national or local emergencies, or any combination of the foregoing. David M. Rubenstein is an anchor investor in Declaration Partners Real Estate Fund II and is not an employee of Declaration. Neither the U.S. Securities and Exchange Commission nor the Securities Regulatory Authority of any state or other jurisdiction has passed upon the accuracy or adequacy of this podcast. Consequently, from the foregoing, no reliance whatsoever should be placed on this podcast, and no decision, including any investment decision, should be made based on this podcast or on the information contained herein. Podcast prepared as of September 5th, 2024.